Welcome back to Deloitte's Public Sector Accounting Standards Update, Keeping Current webcast. I'm now joined by Nura Tayev, a senior manager in her audit advisory practice in Toronto. Nura commenced her career in her Edmonton office, where she worked on audits of public sector organizations and private entities. In 2013, Nura joined our national office, where she became a subject matter expert in revenue recognition. Nura has recently joined our Toronto Audit Advisory practice in Toronto and focuses in on providing services to public companies under IFRS 15, the revenue recognition standard for public companies, and has also been involved with our firm's response to the exposure draft on revenue in the public sector. So welcome, Nura, and we look forward to hearing from you on the updates on the revenue project.
Thanks, Matt. So just by way of some background, back in 2009, the boards had approved a new project on revenue recognition for exchange transactions. The intention here was that the project would expand on the guidance in PS 1200, the standard governing financial statement presentation, as it pertains to revenue recognition for exchange transactions. The boards had agreed that the starting point for this project would be considering the developments of the joint IASB and FASB project on revenue recognition, which began in 2008 and was completed in May 2014, with the issuance of revenue from contracts with customers. So on this basis, in 2013 and 2014, the board issued and received comments on a statement of principles containing the proposals that would govern this proposed standard and would ultimately include a broad range of revenue. Since then, and most recently, the board issued an exposure draft of the proposed standard in May 2017, and comments were submitted back in August. The board plans to begin deliberating the comments received in December with an expectation that the final standard will be approved in the second quarter of 2018. The standard itself will be effective for fiscal years beginning on or after April 1st, 2021, with earlier application permitted. The standard would be considered a change in accounting policy and therefore applied retroactively with restatement of prior periods. So for those of you that are a little more familiar with PSAS, you will note that there are already a number of standards that deal with revenue recognition, and we've noted these on the slide. However, none of these standards address the recognition and measurement of exchange transactions, meaning those transactions where goods or services are provided to a payor in exchange for consideration.
Thanks, Sarah. So just some thoughts. So, with IFRS 15, like when that came out, that ended up superseding all the other revenue recognition standards under that framework, under IFRS. So, with respect to this revenue project, is that going to be the case as well? Like, is it going to supersede all the other revenue recognition standards that exist in PSA?
That's a good question. So no, the existing standards are going to continue to be in place. The scoping section of this proposed standard actually scopes out these transactions that are in the scope of existing revenue recognition guidance. So this proposed standard is really just intended to address exchange transactions and unilateral revenues. So it's not intended to be a comprehensive framework like it is under IFRS.
Mm. So with that then, so did the proposed standard, did that include any pieces of guidance that you found somewhat surprising that, may not be very familiar for entities that report under PSAS?
Yeah, so included in the standard is an appendix that's an integral part of the standard. And I won't go into detail in it today, but I thought it was quite interesting that there's, some guidance now on elements like contract combination, contract modification, and these are, concepts that we don't really deal with under existing public sector standards. So I found that quite interesting. There's also some more detailed and prescriptive guidance on areas like licenses or permits and principal versus agent transactions, which, personally, based on my experience, I find quite timely and relevant to those operating in the public sector. So definitely recommend taking a more detailed read through those proposals.
Yeah, I think from my recollection too, on that exposure draft, certainly driver's license revenues, for example, was one that I think I saw a couple of times.
Yeah.
So definitely an area that you should pay attention to if you're an organization that is, collecting revenue on driver's licenses.
And we'll go through some examples in these upcoming slides on that as well.
Sure.
So focusing on exchange transactions and unilateral revenues, there still remains a broad range of activities that drive these types of revenue transactions. So, it becomes quite important to differentiate between exchange transactions and unilateral revenues, as the nature of the underlying transactions and activities in those two buckets will vary. Exchange transactions, as I mentioned, I touched on briefly before, those are really transactions where goods or services are being provided to a payor for consideration. So these transactions are going to create performance obligations, which are enforceable promises for a public sector entity and arise directly from payment or the promise of consideration by a payor. So on the left-hand side of the slide there, you can see some examples. Unilateral revenues, on the other hand, those are increases of economic resources of a public sector entity without a direct transfer of goods or services. So the right to the economic resources is really attributable to legislation based on a constitutional authority or delegated constitutional authority, and an event entitling the public sector entity to recognize revenue. And on the right-hand side there on the slide, you can see some examples of those types of revenues.
So certainly unilateral revenues would be a topic that is probably unique to the public sector.
Yeah,
right?
exactly. We won't find comparability on that one.
Yeah.
So on to the next slide, performance obligations. So these, as I mentioned, are enforceable promises to provide goods and services. So when assessing whether a performance obligation has been created, the focus really should be on whether the promise has created a valid expectation on the part of the payor that the public sector entity is going to transfer a good or service. So these types of promises can arise in many ways. One of the examples noted in the exposure draft is a public sector entity that issues a driver's license, as Matt had mentioned. So in this case, the payor is providing consideration to the public sector entity in exchange for the right to drive legally. So effectively, when there's an imposition of a fee and the payor obtains specific benefits as a result, this is considered an exchange transaction. Another key factor in assessing performance obligations is to ensure that a distinct good or service is in fact being provided to the payor. So, for example, public sector entities often may undertake administrative activities to ultimately provide a good or service to the payor. A performance obligation is generally not created as a result of these administrative activities, as there's no direct benefit to the payor. When you're making this assessment, the evaluation should really focus on identifying the specific payor, as this will really help distinguish the public sector entity's performance obligations to the payor from those responsibilities that simply result from trying to fulfill its general mandate. The exposure draft also highlights the fact that performance obligations are one of the many types of present obligations that a public sector entity may have, as performance obligations have all the three essential characteristics of a liability as defined in PS 3200. I just wanted to also highlight that unilateral revenues will never create performance obligations.
So in that case, I guess, like when we talk about performance obligations, so unilateral revenues will never create a performance obligation. So theoretically, you're always just going to recognize that revenue as you're entitled to it, right?
Exactly.
Or as you collect it. Whereas, I guess there's other types of revenues where you may be putting it onto your balance sheet if you haven't fulfilled if you've collected cash up front, but you haven't actually fulfilled the performance obligation, right?
Yeah, that's exactly right. Exactly right. And we'll get through some examples here to illustrate that. So the next slide is particularly relevant when we have one or more promised goods or services. So in these cases, a determination will be required as to whether the promised good or service is distinct, because each distinct good or service has a performance obligation that would be accounted for separately. So, some examples of promised goods and services include, the sale of recycling bins, rental of a community center, fees charged by a daycare facility, many more as well. So at inception, an assessment must be completed as to whether each promised good or service in the transaction is distinct. So the proposed standard actually has a framework there to help make that assessment. So to be distinct, it must either be separately offered or provide a separate benefit. When promised goods and services are not distinct individually, they will be aggregated with other promised goods or services until a bundle of distinct goods or services exists. So this will often be the case if the goods and services are, highly interrelated and there's a significant level of service required to integrate the goods and services into a combined item.
You could theoretically, you could have a contract where you've determined that there maybe are some performance obligation, but because you don't think that they're distinct, you've concluded that they haven't distinct, you could actually end up rolling them into one performance obligation overall.
Yeah, that's right. They could be aggregating to a higher level or disaggregating to a lower level, depending on, that benefit and if they're separately offered.
Okay.
So getting into recognition and measurement here, again, important to differentiate between unilateral revenues and exchange transactions, as the guidance is a little bit different. So if we start off with exchange transactions, in exchange transactions, it is possible that more than one performance obligation exists within the transaction, as we've discussed. And if this is the case, additional consideration is going to be required as to how to allocate the total transaction price to these obligations. So the exposure draft proposes doing this on a what's referred to standalone selling price basis. So if we went through an example, a public sector entity could enter into an agreement with a payer to sell a tangible capital asset and service it for the next 2 years. So in this case, although we have one transaction, the public sector entity could potentially arrive at a conclusion that there's two performance obligations here, the sale of the tangible asset and the servicing. So in this transaction, we would have an element of allocation that would have to be undertaken. The standalone selling price is really the price that is observable, and it's charged for the good or service when it's sold in similar circumstances on a standalone basis. There could be some instances where a standalone selling price is not directly observable. In such cases, an estimate of SSP or standalone selling price will be required. And this estimate should really derive an amount that would be a faithful representation of the price the public sector entity would sell the good or service if it were sold separately.
So are there restrictions on how these estimates must be made? Like, would the standard prescribe certain estimation methods that must be used, or?
No, so there's no restrictions. The standard does provide some suggested estimation methods. Expected cost is one, residual is one, but ultimately, it's not prescribed, and the whole objective is to ensure that the amount results in a faithful representation of the price. So as long as it's within those parameters, it's permitted. Another area of significance in measurement I just wanted to talk through is whether there is any variability in the transaction price. So consider situations where there are discounts, rebates, incentive programs, or price concessions. These types of elements all really introduce variability or uncertainty to the transaction price. So variability will be required to be estimated, and this is going to be an area of professional judgment, of course. The standard does propose two methods for estimation: the expected value method, which is a probability-weighted estimation technique, and a most likely amount method, which really selects the single most likely amount in a range of possible amounts.
So what do you do if you're in a situation where a reasonable estimate can't be made then?
So in those cases, revenue actually would not be recognized until a reasonable estimate can be made. There's actually specific guidance also on significant concessionary terms, which requires that transactions that include significant price concessions or lengthy payment terms need to be further assessed, as all or a significant portion of the transaction price may be considered to be in the nature of a grant. And if that's the case, that consideration or a portion thereof would be recorded in accordance with PS 3410. Lastly, I just wanted to also touch on non-cash consideration, which would be measured at the fair value of the goods or services received, adjusted by the amount of any cash or cash equivalents transferred. Now, for unilateral revenues, much simpler, just measure at their realizable value. Recognition, so broadly speaking, the proposed standard includes two circumstances that are critical to revenue recognition. So the first being that the public sector entity has the information required to record the transaction, and the second that it has the ability to enforce payment. Specifically as it relates to exchange transactions, expanding on these broad principles, the objective here is to recognize revenue when the performance obligation has been satisfied. This will be the case when a payer has control of the benefits associated with the good or service. The determination of control passing is based on the characteristics of the goods or services promised and whether control passes at a point in time or over time. indicators of control passing include, but are not limited to, the payor having the ability to direct the use of, selling, or exchanging, and obtaining substantially all of the remaining benefits from the good or service, or holding the good or service and having discretion to use it. If a performance obligation is not satisfied at a point in time, then it will be satisfied over time. And the proposed standard actually includes some indicators that would suggest overtime recognition. So one example would be that the payor is simultaneously receiving and consuming the benefits provided by the public sector entity as they perform and fulfill this performance obligation. So if we go back to the driver's license example, assume a payor is purchasing a 5-year driver's license for $200. If the public sector entity concludes that its promise is simply to issue a license, the public sector entity does not have any ongoing performance obligation and would be eligible to recognize revenue at the point in time when the license is available for the payer. This is the point where the payer holds the license and has discretion to use it, meaning they control it. As it relates to unilateral revenues, revenue will be recognized when the public sector entity has the authority to claim or retain the inflow of economic resources and identifies a past transaction or event that gives rise to an asset. So, with unilateral revenues, it's different because to be recognized, there is legislation, regulations, or bylaws authorizing this fine, penalty, or fee that really has to be in place for the public sector entity to have the authority to recognize this type of revenue. And, just wanted to highlight, of course, that authority is based on the framework and precedence of an individual jurisdiction. So as authority originates in the underlying legislation, the point of recognition may vary amongst various jurisdictions.
Okay. So, I mean, it sounds interesting, like in terms of the driver's license, revenue, for example.
Yeah.
In that case, the issuance of the license, you might be at a situation where you can recognize the full $200, right?
That's right. Yeah.
Whereas I think, maybe a lot of entities out there may be trying to recognize it over the license period. So there has to be a determination, I guess, as to whether or not you have an ongoing performance obligation or not, right?
That's right. Yeah. And if that control has transferred, then you've fulfilled your obligation.
Yeah. So what about if you have like a hybrid transaction, right? So that's like a transaction that has both like an exchange element to it and a unilateral revenue element. So or even an element such as like a contribution or government transfer. How would you go about accounting for those? So
the standard actually has guidance on that, and they do refer to these transactions as hybrid transactions. And effectively, when you have a transaction like this, you're going to have to identify the specific component and account for the components in accordance with the applicable recognition criteria. So think about an example where a museum charges a fee that includes a component that's an admission fee and a donation to preserve artifacts. The portion related to admission would be accounted for as an exchange transaction, and then the portion related to the donation would be accounted for as a donation. So getting into disclosures, as you can see, the disclosure requirements are significant under this proposed standard, and really they're intended to provide the users of financial statements with information regarding the nature, amount, timing, and uncertainty associated with revenue. More specifically, the revenue reported in the statement of operations will need to be disaggregated in the notes by source and type, including a separate disclosure for revenues that are not related to recurring activities. The differentiation between recurring and non-recurring revenue sources is particularly important. It's really intended to assist the users of financial statements better understand surplus or deficits and what are the implications for subsequent years. For revenue that relates to exchange transactions, disclosure will be required around the typical performance obligations and the methods and policies that apply when recognizing revenues for these transactions. And lastly, disclosure around the nature and amount of continuing obligations grouped by category of similar transactions associated with revenues from exchange transactions is required. I also wanted to mention in instances where the public sector entity does not expect to be able to enforce payment, but has the information necessary to record the transaction, disclosure of these amounts should also be made.
So I know disclosures was a bit of an issue for a lot of companies following IFRS 15 and a lot of information, I guess, that the ability to gather that information from their system was a bit of a challenge. So what's the level of detail that's required for these disclosures?
Right. So I think similarly, there is prescriptive guidance, but the level of detail is a bit of a judgment area. So it's kind of a balance of the usefulness of the information to the users and providing them with enough information to really assess the nature and extent of performance obligations that exist at the end of the current period and have been satisfied during the period. So, always keep in mind the greater the volume and extent of judgments and estimates that are going to be used in the revenue recognition process, the more emphasis that will need to be placed on disclosures and their importance.
Great. Well, thank you very much, Nora, for your time today. We really appreciate the insights that you've brought to us on the revenue project. And for our listeners, for those of you who want to find out more from Nora, you can certainly reach out to her or any of our other speakers based on their contact information, which was included in her introduction video at the outset of the webcast. So thank you very much, and have a great day.
Thank you.